Welcome to the October update for the managed discretionary account portfolios. My name is Mark Wenzel. I'm the head of the investment committee here at the Hopkins Group. We discuss the economic environment and any changes within the economic environment that might be a leading indicator of how we should position the portfolios. And this month, while things on the surface showed that things were stable and steady and that we're heading in the right direction, there was some undercurrents that we identified and we're starting to monitor pretty closely. And the first one of those relates to the unemployment levels. And while both here and in the US, unemployment levels remain low, the underlying mechanics of the market started to show some signs that things are changing. So, in that environment, we had sort of some layoffs in regards to full-time employees, and particularly, I guess, in that sort of middle management level. And you saw an uptick of part-time work and hospitality and service work, particularly around that. So while the rate stayed the same, the composition of the underlying market changed quite significantly. The other big thing that happened, sort of even not so much in September, but more towards October, has seen the increase in interest rates in the US of the underlying 30-year bond yield sort of moving up to 5%. And that's a key sort of psychological barrier, but indicates that the bond market thinks that the interest rates are going to stay higher for longer and perhaps even sort of exceed that high of 5%. And particularly in the US, that relates to a couple of things. Again, like any market, the bond market is a demand and supply market, and you've seen the Bank of Japan selling some of its holding in US government bonds, and that's increased the amount of supply. So in order to sell their bonds, they have to lower their price, which increases the yield. And you've also seen the market looking out going, well, obviously the US is running deficits, so the US government's going to have to issue more bonds to fund those deficits, and that's going to increase supply, and that's why you're seeing the bond yields rise, and that's obviously been a concern for markets. And while, again, not incorporated in the September figures in the last 3 weeks, you've seen the equity markets have a bit of a correction. The other area, again, is China. So they are providing stimulus, but it's not really greatly sufficient stimulus. And again, we're monitoring that component for, again, particularly relevant for Australia. If this stimulus doesn't take hold and the consumers within China put their hands in their pockets and save their money, that could have some serious implications for Australia, particularly around, I guess, the resource sector, but various export sectors as well. The other major thing that obviously happened was the Israel-Hamas conflict. And again, while we're monitoring that pretty closely, historically, this hasn't sort of seen any massive changes in markets. The oil price did rise significantly during that period and has maintained those levels. But again, typically, historically, it hasn't seen sort of widespread contagion across other markets. So we're monitoring that closely, but haven't made any changes to the portfolio around that. On the portfolio, I guess really what you saw with the oil price spiking is that energy performed, was the best performing sector, and it has been for the year. So while that continues to happen, some of the managers that we have that don't have oil have not risen as much as perhaps the index, which we do have an exposure to. So it's important to understand that. High bond yields have seen the fixed income part of the portfolio perform really well, and we've maintained that floating rate exposure. We are starting to really consider sort of fixing some of those rates if some of those economic indicators that I pointed out earlier start to indicate that perhaps the US is peaking and that Australia is peaking in terms of the high interest rates, and that they might have to start slowing or dropping interest rates to stimulate the economy in the future. So again, it's a forward-looking thing and something that we're monitoring, and something really that we would like to act earlier rather than being late to the party. So it's something, again, that's going to watch over the next 2 to 3 months. I think, there could be some changes there if the indicators continue to point that there's a softening in the economies both here and in the US. We haven't made any changes this month, but the other, thing that we are doing is looking at hedging the portfolio more. Again, obviously with US interest rates perhaps starting to peak, the interest rate differential is a key driver of the Australia-US interest exchange rate. So, we are monitoring that, and we are looking to add some hedging to the portfolio, again, perhaps over the next couple of months, depending on the economic indicators. With the rise in bond yields, you've seen, interest rate sensitive sectors such as property and infrastructure impacted, and that's obviously had a downward force on those, and so they've sort of underperformed. But we've reduced our weight significantly to both of those sectors, and we've got it there as a diversifier, but not really significant part of the portfolio. So, as I say, we're not making any changes this month, but we are monitoring, various things. And we are monitoring a couple of the managers who have underperformed, and we're just making sure, that we're, reviewing those appropriately to making sure that their investment style can either be replaced or that is not going to, change in the market environment that's going to produce some extra performance. So, we are, continuing to monitor the portfolio with regards to economic changes, and also obviously to, fund manager performance. And I'd say it's a really challenging time to be an investment committee and making investment decisions, but I'm really happy with the portfolio and the way it's positioned and the way it's performed, over the last 2 to 3 years. And it is going to continue to be challenging, but I think from our point of view, having the oversight and having the rigor around the portfolio construction is going to deliver dividends for our investors over the long term. So thank you for taking the time to watch the video, and look forward to seeing you next time.